Just because somebody spent $200,000 building out a space for their business, but that business does no business now, is that space still worth $200,000? That's what we're going to jump into today. Stick around. Welcome to Business Buying for Financial Independence. I'm Tim Delaney, and I help young professionals buy small businesses so they can escape the 9-to-5 and take control of their time, income, and future. If that sounds like you, hit the subscribe button and let's get into it. So I saw this post online. I'm going to read it word for word. It's going to leave us with some gaps and some misinformation that I'm going to make some assumptions on during the course of this conversation. But I thought it was worth discussing, and I thought it would bring up some good points about business acquisition that everybody should hear, because these types of posts I've seen before. So here is the quote from the post online. I saw a retail food listing nearby. Business less than 2 years, clearly struggling, but they built out the space. The owner told me she wanted $180K because she put $200K into building it. She has the same type of business at another location, which is successful, but this one is not. I think she can't break even, or the best case is breaking even without any profit. The lease is 10 years with a 5-year option. The rent all in is $6,000 per month. Typical for the area. The location is good, in a plaza of affluent neighbor with 2 anchors. The business is something I can handle. I know a local vendor to replace this franchise. I may need to modify or remodel something, but nothing big. What is the price range for this type of business? Thank you. So, a lot going on here. I want to cover a bunch of things in this post. Before I even get started, I would love to hear some of your comments on this before and after you hear my take on it. So drop a comment, hit me up on Threads at Tim T. Delaney or on Instagram, and let me know what your thoughts are before you even listen to this whole episode. Let's start with some of the definitions and some of the facts that jump out at me. First of all, I don't even know if the seller is selling a business. It doesn't sound like there's a business to be even bought. It's negative or maybe break even. There's nothing there. And it sounds like the buyer is contemplating just scrapping whatever the seller was doing anyway and putting in their own model of business. Sounds like something similar if they're going to use the build out, but I don't know for sure. So we're going to assume that it's something similar, but they're really not buying the business in this scenario. They're buying the build out. There is I'll get into sunk cost and that build out expense in a minute, but we have the fact that the seller is part of a franchise. That's going to come up a little bit later. Supposedly it's a good location, but the seller is not doing well there. The poster also says the business is something I can handle, and I know a local vendor to replace this franchise. So I don't know if they're thinking they're going to bring in another local business as a second location for that business, or what exactly they're thinking there, but it sounds pretty complicated. And what is the price range for this type of business? Again, I don't think that this person is really buying a business. They're taking over a lease. They're paying to take over a lease in a spot. So rent, $6,000 a month. It's tough to say whether that's high or low because I don't know the area that it's in. I don't know how big the place is. It sounds expensive to me for a startup or an unprofitable business. This particular place has been open for 2 years with no profit. Food related businesses, I don't know if this is a restaurant or a grocery store or something, like it's not crazy to be open for 2 years with no significant profit. It can take a little while for a business like that to really get up to scale because of their very low margins. So I don't know why the seller's giving up on it so quick. My gut reaction would be a hard pass. I would want nothing to do with this. First of all, I don't really love food businesses anyway, for me personally, but just from all these facts that are going on, I really don't love this deal. There are some positives, and we can get into those, and maybe it's the right fit for somebody else, but the first flag that jumps out to me is the seller has another profitable version of this business. I'm going to assume it's the same franchise in another location that does well, and she couldn't make this location work, even though it was a good location. So why couldn't a successful, profitable business owner take that exact same model and make it profitable in this other location? Is the rent too expensive? Is the location really not that great? Are there other factors, other competitors in the area that are making it tougher in that spot? Maybe it is just that the seller didn't put the time and energy necessary into it. You could make that argument that she opened a second location, not really wanting to spend the time and energy on it, and that's why it's floundering. That's a possibility. I will give her the benefit of the doubt on that. Second factor for me is that build out cost is what I refer to as a sunk cost. May have done another video on this, but I will do one if I haven't, or another podcast episode on sunk cost. But a sunk cost is an expense that goes out that is spent. No matter what you do, you're not going to get that expense back. You can't factor that in to throw good money after bad. For example, a common example used is like in a research and development situation. Company spends $1 million developing a new product that they think they're going to sell for $100 a pop that costs them $50 to make. So they're going to make $50 per product. Over time, they would recoup that $1 million and then make a profit. When the company finishes all that R&D, spend $1 million on it, all of a sudden they realize that it's actually going to cost them $150 to make, but they can only sell it in the market for $100. So now they would be losing $50 for every product they sell. They would never recoup that $1 million. It doesn't make sense to go forward with that project. Even if it cost them $90 and they were making $100, it still might not make sense for them to move forward. That $1 million is a sunk cost. They spent it. There's no sense chasing that $1 million with something that is not going to be profitable in the long run. So this $200,000 that the previous person spent on the build out, that's a sunk cost. It's done and over with. You can't expect to get that money back, and if the business that is operating in that is not profitable. So there's options to be had. I mean, the owner's spending $72,000 a year in rent. From her perspective, she can probably give away that space and be happy that she's going to save $720,000 over the next 10 years, rather than try to recoup close to that $200,000 in a sale. It's just not, it's not feasible for her. And then, on that lease aspect, for a buyer to commit to that $6,000 a month for the next 10 years is a pretty big risk with a non-functioning business as it is. Where are you getting that money to pay the lease every month? Especially now you mentioned that you might need to do a small change, small build out. It's going to be a month or two minimum to do something like that, which means that that's months without revenue. A lot of times when a company is going into a plaza like this and doing a substantial build out or renovations, they will negotiate with the landlord to get a couple months free during that renovation so they don't have to pay while they're building out. Not always, but it happens. I actually just signed an extension with one of my tenants who was doing a major renovation in their space, and I gave them a 1-month rent abatement because they're going to have to close their store and they're not going to have the revenue for that month. That happens. But to jump in with the ongoing lease as it is, the landlord doesn't need to give them any concessions whatsoever. And then on that lease, the term of that lease, I normally really like long-term leases for a business because it keeps your place secure. That's why I bought the plaza where my store is, so that I knew that I would never have to deal with a landlord that wanted to kick me out or raise my rent when the lease was up. So usually for a small business, a long-term lease is a great thing. However, if you are just starting from scratch and you've never done this before, it can be a very risky proposition. Like I mentioned, you're on the hook for all that money for a very long time. Most landlords require a personal guarantee on top of the business signing. So it's something that I would be really kind of thinking about in the back of my mind. Again, this successful owner that has a successful other business failed at this location. There's something not right about that location. Let's talk about the actual value of this deal. It's really tough for me to say it's worth anything because the business is not making money. There's really no value there. Now, if you want to be generous, you could say that the equipment and the facility and the build out is worth something. Yes, but it's not worth the $200,000 anymore, especially if it was designed for a specific franchise. This is another thing that makes me a little bit wary of the deal. This buyer is talking about putting in a different company. With some franchises, they are particular about their space. Does this seller have a long-term agreement with the franchise? Is somebody else going to be able to go in there and change the name and the look and feel of the place? Or if they don't change the look and feel of the place, Could that franchise come back and file a cease and desist because they're infringing on trademarks? So these things are going to really have to be looked at carefully as part of the value. But I would ballpark the equipment, facilities, and again, without knowing a lot of stuff, in the low tens of thousands if you want to be generous. And again, I'd be very hesitant to do that because of that long-term lease lock-in. Unless the seller was willing to still hold the personal liability, personal guarantee on that lease, and you could give it a shot for low tens of thousands on your own business without that overhang of a long-term lease that you're on the hook for, whether the business succeeds or fails. Food businesses, restaurants are typically trading or selling in like the 1.25 to 3.5 times seller discretionary earnings. If this business is making $0, 1.5, 3.5 times zero is still zero. So the business is really not worth much at all. It would be a complete asset sale, and used food business, kitchen facilities, things like that usually sell for pennies on the dollar. Her alternative, the seller's alternative, if she can get out of the lease, is going to be to have some auctioneer company come in and auction off the items where they're going to go pretty inexpensively. They've been there for 2 years already. They've lost almost all their value. Looking at it from an ROI perspective, again, $0 profit divided by $180,000 purchase price is a $0 ROI. So 0% ROI. It's not a great purchase. As I mentioned, that franchise issue is a potential red flag. That who knows what's going on with that. That would need to really be clarified during due diligence. I guess kind of what this comes down to. I mentioned I've seen posts like this before where somebody is going to buy a failed business or take over a location for somebody. Don't be the sucker that's paying for somebody else's mistakes. I love confidence. I talk about it a lot that people should have more confidence in themselves to go buy a business, and a lot more people have the skill set to go run a business than they give themselves credit for. However, not a lot of people have the skill set to turn around a failing business or a failed business. That is a completely different skill set. And you don't want to pay for somebody else's mistakes, especially in this situation where it wasn't even like, oh, you could point to this woman and the seller and say, she didn't know what she was doing. It was her first time doing this. She made this mistake. She made that mistake. And maybe talk yourself into the fact that you would do things differently and better. This is a seller that already has an established profitable business. The same thing. So if she couldn't do it, why do you think you can do it and do it better? Cash flow is not there. Cash is king. You need cash flow to support and sustain a business. If the business isn't profitable now, it's unlikely that you're just going to magically make a bunch of profit come out of thin air. So cash flow, not there. Don't like the deal for that reason. That long-term commitment make me nervous in this situation. Said normally I like a long-term commitment, but for a startup business, it's a little scary. I guess the only kind of potential positive would be if you can improve a model that is going to give you super high ROI, hundreds of percent ROI in a short term, because you know something or you have something that is really going to change the way this business operated. Maybe I'd look at spending some money, but definitely not that $180,000 the seller is looking for. Making sure that you're also checking the fine print in that lease document before you sign anything. They mentioned that there's 2 anchor tenants in this plaza, which makes me believe that it's a pretty large plaza with probably a fairly sophisticated owner, which probably means a very thick, thorough lease with lots of caveats and things in it. There might be issues with even transferring ownership. There might be issues with the personal guarantee and how that's treated. So just making sure that you're reading all that. And then, from that perspective alone, hiring an attorney to go through that lease document as part of due diligence is going to be pretty time consuming and cost you a lot of money if you do it right. That just keeps adding on to your expenses. You're going to be well over $200,000 into this deal if you pay her $180,000. So for all those reasons, I am not super interested in this, and I would really caution anybody against buying or taking over a location where a previous business has failed. I personally have not seen many situations where I've seen a business that went out of business and somebody came in and did the same thing in the same space actually succeed. Usually a lot more to it than just thinking that you can do it better than the previous person. Hope you found this enjoyable. Now that I've gone through all my reasons why I wouldn't do this deal, I would love to hear your secondary comments. Hopefully you took a minute to drop your thoughts before I went into mine. And now I'd love to hear some of your follow-ups on my takes and what you think, where you think I'm wrong and where you think I'm right. Enjoy having conversations about stuff like this, so please don't hesitate to reach out. Look forward to talking to you all again soon. Cheers. Thanks for listening to Business Buying for Financial Independence. If you're serious about owning your time and building long-term wealth, make sure to subscribe so you don't miss the next episode.